It is 8:28 a.m. Pacific Daylight Time. It is the 18th day of June, 2025, and this is episode 1118. So there's some numerology involved in today's show. Not sure what the hell that is, but doesn't really matter. We've got news. It's the news you can use. This is Bitcoin, and I got BBVA, which is a Spanish bank, telling people you should probably buy some Bitcoin. And then the Genius Act is passed. Not sure where it goes next. It's possible it goes to the House. I've noticed that it is very difficult for news stories, whether they're European-based or here in the United States, to actually say where the thing goes next once it's passed, right? Because I thought the Genius Act came out of the House and went to the Senate, and now it's passed, and they're saying it's one step closer. Who knows? But there's some interesting things involved in this particular, what am I trying to say? This article, it brings up some things about the Treasury that I think are pretty interesting. And Israeli hackers seem to have destroyed an Iranian bank. And I think the same hackers may have destroyed an Iranian Bitcoin exchange. We'll get into that one. There's a lot of interesting issues going on with, mining factories opening up in the United States to get around the Trump tariffs. I am here to tell you, you're not getting around Trump tariffs. This is exactly what the Trump tariffs were supposed to do, was to bring manufacturing back to the United States. It's not that you're dodging anything. It's simply that you are, doing what the orange man wanted you to do in the first damn place. Getting a divorce? You got crypto? I think people are wising up as far as lawyers in divorce court are concerned. And then we've got a couple of firms here buying some Bitcoin as usual. There's an interesting take here about Similar Scientific and their quote unquote MNAV, and that's their how much of a premium their stock price is versus how much Bitcoin they hold. This particular article says it's bad. I'm actually of the mind that this may be kind of good. We'll get into that one. And then finally, we've got, Vinaz is raising a whole bunch of money. I guess they're going to buy Bitcoin with it. But first, the Spanish bank BBVA has told its wealthy clients, because if you're a pleb on the street, they probably didn't tell you this one. They've told their wealthy clients to invest up to 7% of their money into Bitcoin. Not 1%, not 2%. Ladies and gentlemen, 7%. Jenna Montgomery from Bitcoin Magazine says Spanish bank BBVA is now advising its wealthy clients to invest up to 7% of their portfolios in, crypto and Bitcoin, showing how traditional banks are starting to see the potential of Bitcoin. Quote, with private customers, since September of last year, we started advising on Bitcoin, said Philippe Mayer, head of digital and blockchain solutions at BBVA Switzerland during the Digi Assets conference in London. Quote, the riskier profile, we allow up to 7% of portfolios in crypto, end quote. The bank's private wealth division is currently recommending clients allocate 3 to 7% of their portfolio to Bitcoin and shitcoins, depending on their individual appetites. While many private banks have offered to execute Bitcoin and crypto trades upon request, it remains rare for a global financial institution to formally advise clients to buy. BBVA is currently recommending allocations specifically into Bitcoin, and they actually say that here in the article, so that's interesting. Mayer emphasized that even a modest allocation to Bitcoin can have a meaningful impact on portfolio returns. Quote, if you look at a balanced portfolio, if you introduce 3%, you already boost the performance. At 3%, you are not taking a huge risk, end quote. BBVA began executing Bitcoin purchases for its clients all the way back in 2021, but Mayer said that this is the first time it formally advised allocations. In June of 2021, the bank launched Bitcoin trading and custody services through its Swiss subsidiary for private clients. Quote, with this innovative offer, BBVA positions itself as a benchmark institution in the adoption of blockchain technology, said BBVA Switzerland CEO Alfonso Gomez at the time. BBVA's interest in digital currency goes back even further. As early as 2015, the bank made it clear that it viewed Bitcoin and blockchain technology as more than just a passing trend. In a statement that now seems increasingly prescient, BBVA said, quote, institutions that understand Bitcoin and digital currencies will lead the new monetary system, end quote, highlighting its belief that early adopters would gain a strategic advantage. This early support set BBVA apart from many of its peers, as a few major banks were willing to publicly engage with Bitcoin at the time. What began as interest in blockchain technology has turned into direct investment guidance, now culminating in BBVA formally advising wealthy clients to allocate up to 7% of their portfolios into Bitcoin, a clear sign the bank sees it as a long-term part of its future. So I didn't even know BBVA had been talking about Bitcoin since 2015. Now, that's when I got into Bitcoin, was the summer of 2015. September, in fact. Early September is when I got in. A European bank of this size is nothing to sneeze at. A European bank of this size advising its clients to buy Bitcoin is also nothing to sneeze at. But what is blowing my mind here is they're giving a number, 7%, up to 7%. Now, while that's still single digits, that's a lot better than a lot of people are. I mean, I've even seen hardcore Bitcoiners say, just take 1%, man. Just take 1%. These guys are going up to 7. They're 7x. Even some hardcore Bitcoiners who have been advising people to get into Bitcoin and DCA for years, and yet they're still saying 1%. And here we have a very massive, and BBVA, don't be misinformed. BBVA is massive. And when they're advising their wealthy clients to 7% Bitcoin allocation, that's kind of a big deal. But we've got the genius bill passing the Senate. Aaron Wood, Cointelegraph. The Senate passes the genius stablecoin bill amid concerns over systemic risk. The U.S. crypto industry is celebrating, I say, as the Genius Act, a framework for stablecoin regulation, was passed in the United States Senate on June the 17th. That would be just yesterday. The bill passed 68-30 in a bipartisan effort, roughly 6 weeks after Tennessee Senator Bill Hagerty introduced it into the Senate. It will now head to the House of Representatives, where Congress must reconcile it with the House's own Stable Act, which also seeks to regulate stablecoins. So I guess the Stable Act is the House's, and I guess it goes to the Senate. The Senate was the Genius Bill, and now it goes to the House. I really don't like the fact that I had to scan three different articles about this passage of the Genius Act. And I still cannot really get a handle on exactly what happens next, because there's a lot of these things said it's just one step away from being law. And I'm like, well, isn't that the signature of the president? Because right now the Genius Act is just passed the Senate, and now it goes to the House, and then it's got to go to the president of the United States for his signature. That's 2 steps, not one, but whatever. The act holds a number of provisions, from rules for issuers, anti-money laundering measures, and mandatory one-to-one backing of stablecoins with reserves like U.S. dollars and short-term treasury securities. Lawmakers say the bill will offer clarity and stability, but economic and legal observers have noted that the backing clause of the Genius Act could pose a systemic risk to the United States monetary system. And I think they're getting at the Treasury, the short-term Treasury backing. Let's see what these guys say. Haggerty said, this bill will cement U.S. dollar dominance. It will protect customers. It will drive demand for U.S. Treasuries. What have I been saying? Drive demand for U.S. Treasuries. Who will demand U.S. Treasuries? Tether and probably Circle. They're going to demand to buy those Treasuries so that they can print their Tether and their Circle or whatever, the USDC and their USDT. I've been saying it forever, and I think that I'm actually right. The Genius Act's preference for U.S. Treasuries as a backing asset has concerned some observers. Professor Yisha Yadav at Vanderbilt University and Brendan Malone, who formerly worked in payments and clearing at the Federal Reserve Board, released a paper on June 10th detailing their position. The bill, according to crypto-focused lawyer Aaron Brogan, quote, deputizes stablecoin issuers as wholesale buyers of U.S. debt. The one-to-one collateral rule funnels new token revenue into Treasury bills, end quote. It's not exactly how I'm thinking about it, but we'll go with it. The authors are concerned that backing stablecoins is not scalable with the current state of the U.S. Treasury market. Yadav and Malone say that Circle has a circulating supply of $60 billion, while around $900 billion is traded in secondary Treasury markets. This means that currently, if an issuer like Circle were to liquidate its assets, there will likely be sufficient counterparties to which it could sell its treasuries. However, this is subject to change if the stablecoin market continues to grow, which the authors note that it has. Quote, stablecoins have experienced surging growth in the last 5 years, with issuance expanding from around $2 billion in 2019 to around $230 billion in outstanding claims by the first quarter of 2025. End quote. Furthermore, the Treasury market has run into liquidity problems in recent years, which are the result of 4 factors. 1, high-speed automated securities dealers are providing stiffer competition to primary lenders. 2, post-2008 regulations require banks to have deeper rainy day buffers of capital. 3, numbers 1 and 2 combined mean banks confront powerful incentives to avoid participating in Treasury markets. And 4, outstanding tradable Treasury debt, which a Treasury security represents, has grown from $4.8 trillion, that's trillion with a T, dollars in August of 2008 to $28.6 trillion by March 2025. Holy crap, do the division. These factors combined mean that there are fewer counterparties available to purchase the type of large-scale movements of debt that one would expect if a stablecoin firm were to experience insolvency and there was a run on redeeming its tokens. The authors noted that neither the illiquidity of Treasury markets nor the possibility of a stablecoin issuer is hypothetical. Circle saw $2 billion in USDC removed from circulation in the days following the collapse of its banking partner, Silicon Valley Bank. Treasury markets saw a liquidity crunch in March of 2020 during the COVID-19 market chaos, where investors could not find counterparties to trade their treasuries, causing prices to become deeply distorted. Pausing to say, isn't that what markets do? Set the price? And if nobody wants to buy a thing, that price actually goes down? How's that an actual distortion? The markets were signaling, we don't want this crap, but whatever. This happened again in April of 2025 when Donald Trump made radical shifts in U.S. trade policy with new tariffs. Quote, Treasuries trading experienced severe illiquidity and unusual price movements. Investors could not trade smoothly, invariably triggering concerns about the causes of this latest breakdown, end quote. So what does it all mean? Yadav and Malone state that increasingly illiquid treasury markets and the quickly growing stablecoin ecosystem both create risks for each other. In the event of a large stablecoin issuer experiencing a run on stablecoins, illiquidity in treasury markets and a lack of counterparties could prevent the issuer from being able to sell its securities, and it would become insolvent. This could also affect the credibility of treasury markets themselves. Quote, growth of the treasury or the stablecoin industry appears to be taking place without significant regard for the capacity of the treasury market to sustain this growth in practical terms, the authors state. You know, I'm going to pause here just to say that it sounds to me like they have this wishful thinking that the United States isn't going to just print treasuries. They are. Okay, continuing. It could also change U.S. financial policy and decisions on how the government funds itself. Short-term obligations make up around 1/4 of Treasury debt. Preference for 10 and 30-year bonds means that policymakers can typically plan out various initiatives that require decades-long spendings. Under the Genius Act, stablecoin issuers should preferably back their assets with short-term treasuries. If the current composition of Treasury debt shifts to favor of short-term, then, quote, regulatory objectives for stablecoins may well shape how the United States government funds itself and the cost that it has to pay to do so, end quote. Yadav and Malone conclude with 3 policy implications. 1. Regulatory coordination between stablecoin policymakers and the overseers of treasury markets. 2. Ensure market-making practices in secondary treasury markets can manage increased demand from stablecoin issuers. 3. Maintain the country's credit worthiness. The growing interconnection between treasuries and stablecoins, quote, signals a policy imperative to ensure that the advantages of each amplifies the other rather than their fragilities undermining the whole. To their credit, regulators appear to be making changes to limit these risks, but it remains unclear how effective it will be. Before the Genius Act can potentially impose systemic risks on the American financial system, it first has to pass the House of Representatives. The bipartisan hurdle for crypto may well be over with the vote in the Senate. Last year, the House of Representatives voted and passed a crypto bill which was sent to a Democratic Senate where it failed to make it on the docket. If members are just as amenable to pro-crypto legislation as they were just last year, the remaining issue is to reconcile the bill with the House's Stablecoin Transparency and Accountability for a Better Ledger Economy, or STABLE Act. Per a report from blockchain intelligence firm TRM Labs, quote, the 2 bills differ in structure and scope. Both reflect a growing bipartisan understanding of stablecoins, end quote. Key issues for discussion include the structure of federal oversight, coordination, and state regulators, and the regulatory treatment of algorithmic stablecoins, political concerns, namely the degree to which Trump could profit from the bill, still linger, and Senator Elizabeth Warren said this bill that was written by the industry that will supercharge the profitability of Donald Trump's crypto corruption while it undercuts consumer protection and weakens our national defense. Okay, Pocahontas, I think you're a little bit going into hyperbole, but, you know, she's going to be hysterical no matter who does what. Ranking Democratic Congresswoman on the U.S. House Committee of Financial Services, Maxine Waters, has also been a vocal critic of Trump's activities in the crypto world. Waters and other high-ranking opponents to the industry could hold up the bill. Democrats on the fence may also be swayed by Trump's increasing involvement with the industry, which many in the crypto space see as delegitimizing, and the president's tanking approval ratings. I'm not actually seeing all this. I'm not really seeing the tanking approval ratings, honestly. Not really seeing it at all, but hey, you know, it is what it is. It's hard to find any kind of, you know, completely neutral territory when it comes to news about Orange Man and all the rest of these jokers. Still, though, the breakdown of how the treasury market interacts with stablecoins, I think, is interesting. I still think that they get it generally wrong. I really am going to just continue to cling on to my thesis like a baby with a security blanket and say the United States is going to use stablecoins to export exponential amounts of United States debt instrumentation in the form of treasury bills and bonds. The people that are going to buy them are going to be stablecoin issuers, and when they do, they're going to issue stablecoins to reflect what's on their balance sheet. It is a de facto shadow Federal Reserve / Treasury system that is outside the direct general control of the United States federal government. That's what it is. And this notion that, oh, well, stablecoin, these two factors could coincide that causes some major problems. The chances of there being a run on stablecoins at the same time that nobody wants to buy a treasury so that, nobody can actually sell the treasuries, I think is kind of like counterintuitive, because if there's a run on stablecoins, exactly in what way is it a run? Are people trying to sell their stablecoins and exchange them into US dollars? That doesn't sound like a run. A run on stablecoins means you're trying to get your stablecoins, which means that it's in the best interest of the stablecoin issuer to issue more stablecoin, which means buying more treasuries, which means the United States gets to print and monetize immediately more debt instrumentation. I far be it from me to argue with people with PhDs in economics and are hanging around with Nobel laureates, glad handing each other at $500,000 a plate fucking luncheons and shit. But I don't think these people understand what's actually going on. It is what it is. Hey, maybe we should clear our minds. Let's do it with Oshi. From oshigood.us, the Circle P is open for business. It's where I bring plebs just like you that have goods and services for sale in Bitcoin to plebs just like you who want to buy those goods and services in Bitcoin. Oshi at oshigood.us. That's oshigood.us. Has BTHC nodes. They're little chocolates. And from what I understand, they'll get you high. Each bite contains approximately 15 to 20 milligrams of THC, infused with a blend of ghee butter and my proprietary HODL butter. Interior is the HODL bar batter and covered in a hand-dipped Mexican-style stone ground 70% dark chocolate. It's so good. They're about 1/3 of an ounce per bite. There's 10 bites per jar. And here's the suggested use. Just start with one node. If you're going to be self-sovereign, you only need really one node. But if you wait about 30 to 45 minutes, maybe you're only feeling a light effect of your newfound sovereignty. So feel free to chew into another one. Taste, chill, and enjoy responsibly. Here are the ingredients, just so you know. Dates, pecan butter, which is pecans, maple, sugar, cinnamon, sea salt, black pepper. There's peanut flour, cacao powder, peppermint extract, THC, ghee butter, cinnamon, vanilla extract, and sea salt. That is the best list of ingredients. You know what's not in there? A whole shit ton of stuff you can't pronounce. Like polyabsorbate red number 5 or some bullshit like that. Anyway, you can get all of Oshi Good products over at oshigood.us. That's oshigood.us. In the order form, put in Bitcoin and. Oshi's not really doing a discount, but the way Circle P works is that when you buy goods and services from a Circle P vendor like Oshi to get his BTHC nodes, right? Then Oshi, if he knows where he made the sale from, is going to be able to determine, hey, it came from Bitcoin and how much do I pay this guy? Oshi gets to make that determination. This is the value for value advertising model. You will not find it anywhere else in this ecosystem. I did it all by myself and my friends who are my vendors like Oshi and Leathermint and Soap Miner and on and on and on. These guys are what make circular economies happen. Because if you're not selling your goods and services in Bitcoin, you're not in the Circle P. On to suspected Israeli hackers claim to destroy data at Iran's bank SEPA. SEPAH. Not exactly sure how to pronounce that one. This is out of Reuters, by the way. AJ Vincent's is writing. An anti-Iranian government hacking group with, oh my God, potential ties to Israel and a track record of destructive cyber attacks on Iran claimed in social media post on Tuesday that it had destroyed data at Iran's state-owned bank SEPA. The group, known as or Predatory Sparrow, hacked the bank because they accused it of helping fund Iran's military, according to one of the messages posted online, of course. The hack comes amid increasing hostilities between Israel and Iran after Israel attacked multiple military and nuclear targets in Iran last week. Reuters could not immediately verify the attack on Bank of SEPA. The bank's website was offline on Tuesday, and its London-based subsidiary, Bank SEPA International PLC, did not immediately respond to an emailed request for comment. Customers were, however, having problems accessing their account, according to Israeli media, and the Sparrow Group did not respond to multiple messages sent via social media, quote, disrupting the availability of the bank's funds or triggering a broader collapse of trust in Iranian banks could have major impacts there, Rob Joyce, the former top security official of the NSA, said in a post on X. In 2022, the group claimed responsibility for a cyber attack against Iranian steel production facilities. The sophisticated attack caused a large fire at the facility, resulting in tangible offline damage. Such attacks are usually beyond the capabilities of activist hackers, security experts say, and would be more in line with the capabilities of, a nation state. So, why bring this to you? Because banks. If your money is tied up in a bank, then you have third-party risk. And that third party could be an activist group that takes all the data offline. So what we've heard about this from other outlets, this is Reuters, but other outlets have said that all ATMs for the Bank of SEPA in Iran are down, and nobody can get any money out of those ATMs. The website is offline, or in other reports, the website was online, but all of the account information of all the customers of Bank of SEPA had been erased. All the ledgers erased. Now, again, we don't really know. These are anecdotal reports that are coming in. But the reason that I'm even bringing it to you in the first damn place is banks are not secure. And it's worse and worse and worse and worse. So what is not offline is anybody in Iran that has Bitcoin. Anybody in Iran that has Bitcoin but still has some kind of access to the internet. And honestly, you could even send a transaction via radio, although you were definitely in the nerd component of Bitcoin at that point. And people will say, yeah, but I think Iran's entire internet is offline. That is a bummer. There is no doubt about it. That is definitely a bummer. But I would rather still have my Bitcoin's ledger intact and not be able to use it than to have the entirety of my financial history flushed down the financial toilets of history because an activist group decided that they really just wanted to do this kind of damage. Just be aware, this is probably going to get worse before it gets a lot better. Just saying. Just saying. Okay, now, that same group has drained and apparently burned $90 million from an Iranian exchange, specifically a crypto exchange named Nobitex, Vismaya V from Decrypt. A pro-Israel hacking group has claimed responsibility for breaching Iran's largest crypto exchange, draining more than 90 million in digital assets while warning of further attacks on what they described as regime-linked financial infrastructure. The attack on Nobitex was first reported by blockchain investigator Zach XBT Wednesday morning, who saw hackers exploit multiple blockchain networks using provocatively named wallet addresses, including TKFUCKIRGC terrorist NoBitTex, and then some other numbers. So TK fuck the Iranian Republican Guard terrorist NoBitTex. That's that vanity address is that's a large vanity address. So even if it is on the Tron network, and it is, it was probably fairly difficult to spin up. Anyway, the stolen assets include 49.3 million in Tron, 24.3 million in EVM compatible chains, and $2 million in Bitcoin, 6.7 million in Dogecoin, according to blockchain security firm Civers. The breach at Nobitex appears to stem from critical failures in access controls, allowing attackers to infiltrate internal systems and drain hot wallets across multiple blockchains. Yet, surprisingly, the funds stolen remain unmoved. Okay, that doesn't wash with the headline that says it was burned, but let's find out. The funds were essentially burned permanently and cannot be touched unless stablecoin issuers were to reissue the centralized stablecoins, Zach XBT reported. Interesting. According to Elliptic, a blockchain and analytics firm, creating vanity addresses with text strings as long as those used in this hack are computationally infeasible, meaning the hackers do not control the private keys for the addresses in question, effectively burning the funds in order to make a political statement. Oh, wow, okay. The hacking group Ganji, or the Predatory Sparrow group, claimed responsibility for the attack in a tweet on Wednesday. The Nobitech exchange is at the heart of that regime's efforts to finance terror worldwide, as well as being the regime's favorite sanctions violation tool, the group declared, threatening to release the exchange's source code and internal data within 24 hours. The hack represents the latest escalation in cyber warfare between Iran and Israel. Nobitech serves as a critical gateway for crypto transactions in Iran, where traditional banking faces severe restrictions. Quote, Nobitech's identified unauthorized access to parts of its infrastructure, specifically affecting our internal communication systems and a portion of our hot wallet, Nobitech tweeted. The exchange said it suspended platform access for a security audit and said most users' funds remain safe in cold wallets. Most, but not all. Nobitech noted that it's working with the Iranian Cyber Police, also known as FATA, and other agencies to recover the assets. Well, if that vanity address that I gave you is in fact absolutely true, and it's a burn address, then you're gonna have major problems. Anyway, I was unaware that Iran even had a crypto exchange, and it looks like it's been taken offline, maybe permanently. I don't know, man. But again, as with banks, do not trust, especially your Bitcoin, to an exchange. This is a very good reason to get your Bitcoin off of exchanges. Meanwhile, let's run the numbers. Futures and commodities. West Texas Intermediate is down 1/4 point, but still way high. $74.70 per barrel. Brent North Sea is down 1/3 to 76.16. Natural gas is up 3 full points, probably because a major attack on natural gas facilities in Iran was conducted sometime yesterday. $3.96, damn near $4 per 1,000 cubic feet. Again, we haven't seen prices this high on natural gas in months. Gasoline is up 0.8% to $2.30. Gold is crab walking, but in the green, $3,407.05. Silver is down 1/2. Platinum is up 4 points. Copper is up 1 point. Palladium is crab walking in the red. Ag is fully mixed today. Biggest loser seems to be chocolate, 4 points to the downside. Biggest winner going to be wheat, which is 4 points and change to the upside. I got live cattle. It's up 0.2 of a point. Lean hogs are down 0.2 of a point, and feeder cattle are up 0.2 of a point. The Dow is up 1/4. The S&P is up 1/3, as is the NASDAQ, and the S&P Mini is up 0.86%. What's Bitcoin doing? $104,200, because nobody can get their shit straight. Oh, well. That is a $2.07 trillion market cap. You can get 30.6 ounces of shiny metal rocks with your 1 Bitcoin, of which there are 19,880,397.71 of. And average fees per block are kind of high, same as yesterday, 0.05 BTC, taken in fees on a per block basis. There's 1 block, only 1 block. Oh my God. And it's carrying a measly 2,000 unconfirmed transactions, waiting to clear at high priority rates of 1 Satoshi per VByte. Low priority is going to be 1 Satoshis per VByte. We've had a fairly precipitous drop in hash rate on the mining for Bitcoin. We are now at 890.7 exahashes per second, but fear not, that's way more hash power than honestly we've had in a long time. It's not the 980 exahashes that we've seen in the past, but like just a couple of years ago, we were at 400. So we're twice the security now. So anybody who's telling you, oh my God, mining's going to die and everybody's Bitcoin's going to be taken, is just don't know what they're talking about. Okay. So apparently X did not like my post of yesterday's show, yeeted off the timeline. They don't say why, other than that there was something offensive about it or possibly derogatory. And I'm still trying to figure out why they put a warning label on my tweet for this particular show. I literally don't know why, but from yeeted off the timeline, yesterday's episode of Bitcoin And, I got TK giving me 10,000 sats. Brother, thank you. He says, fatty zap for loads of episodes consumed. Being someone who hosts spaces daily, finding relevant content that isn't hype or fluff is tough. Turkey, speak to us. Pies, I know you're listening. Yodel, stay strong. Psyduck, say the thing. Bitcoin for President with 5,000 says, love the show. Please keep the show going because it is a fantastic resource for a great information diet. Well, thank you, Bitcoin for President. I appreciate that. Owen, 1971 Sat says, back on Fountain after a hiatus due to technical issues. JB55 just zapped me 1971 Sats, so I'm passing them along to Bitcoin And. Thank you. No, thank you. Progressively Worse with 1,000 says, thank you. No, thank you. And Psyduck saying his thing with 719 Sats. Psyduck. Jay with 555 says, you'd think that people would be over the moon with so many companies buying Bitcoin. Bitcoin in every pocket and Bitcoin in every treasury is how you build the potential energy that can eventually power a Bitcoin economy. You know how many people are going to disagree with that? Loads. Why? I don't know. From my standpoint, I got to go back to first principles. Can I stop Van Eck from buying Bitcoin? The answer is no. So therefore, I'm not going to worry about it. The one thing that I would worry about is if that answer was yes. Bitcoin is for everybody, including the people that you don't like. If you were able to make sure that somebody you didn't like wasn't able to purchase Bitcoin, then somebody who doesn't like you is going to have the same power. And that's not good. Yodel with 511 says, Batman is back. Hey, Jay. Turkey with 500 says, nothing. God's Death, 237. Thank you, sir. No, thank you. Permanerd with 210. That was a fun ride. I'll see you on the other slide. And Pies with 100. Thank you, sir. No, thank you. That's the weather report. Welcome to part 2 of the news that you can use. Bitmain, Canaan, and MicroBT open United States factories to dodge Trump's tariffs. Like I said at the beginning of the show, you ain't dodging shit. You're doing exactly what Trump wants you to do. Bring manufacturing back to the United States. Will it work? Well, I guess in this case it did. According to Reuters, 3 Chinese giants dominating global ASIC device production, Bitmain, Canaan, and MicroBT, have launched a strategic shift towards the United States driven by steep tariffs enforced by the Trump administration. The move is a direct response to American protectionist policies. Trump introduced 30% tariffs on Chinese tech products, heavily impacting a sector where China controls over 90% of global mining hardware production. Bitmain led the way, starting device assembly on U.S. soil last December, just 1 week after Trump's election victory. Holy shit. Canaan quickly followed, launching a pilot production line in the U.S. to bypass the heavy import taxes. Leo Wang, Canaan's VP of Business Development, called the American project exploratory, highlighting the unpredictability of current trade policies. MicroBT, the world's largest player, announced it was actively rolling out a U.S.-based localization strategy. Guan Yang, chief technology officer at Conflux Network, noted that, quote, the U.S.-China trade war is triggering structural, not superficial, changes in Bitcoin's supply chain. For American firms, this shift represents a strategic pivot towards politically acceptable hardware sources. Wow, that's an interesting way to put it. Politically acceptable hardware sources. Yang added, the near monopoly of the 3 Chinese mining giants, which according to Frost and Sullivan accounted for 95.4% of the global hash rate sold in 2023, has raised national security concerns in the U.S. Quote, while over 30% of global Bitcoin mining occurs in North America, more than 90% of mining hardware originates from China, representing a major imbalance of geographic demand and supply. So is it working? Well, when I see things, that say actively rolling out a United States-based localization strategy, there's a couple of other telltale signs that maybe they're not really building as big of facilities in the United States as we think. Maybe they're just, I don't know, like assembly facilities, and that all the actual stuff is basically still made in China. And somehow, maybe they're even smuggling the like chips and boards and stuff in and assembling them here and somehow get around the tariffs. It depends on how the tariffs are structured. But localization strategy does not sound to me like it's actually building, an assembly line factory in the United States. But I'll keep my eye on it for you and report back later. But meanwhile, are you on good terms with your wife or your husband? Are you a Bitcoiner? You might want to listen up to this one. Crypto and Divorce. A lawyer outlines common red flags that a spouse may be hiding assets as disputes grow. I was not aware that our divorce is growing. Maybe James Hunt from theblock.co will tell us. From Bitcoin to meme coins, digital assets are no longer fringe bets. They're showing up in everyday portfolios, mobile wallets, even grocery store ATM transactions, and now divorce settlements. As cryptocurrency adoption grows, family lawyers are increasingly grappling with how to uncover, value, and divide holdings in contentious splits. What was once a niche asset class is now one of the most complex and potentially largest elements of the marital estate. Modern prenups and postnups increasingly include clauses that define crypto as separate or marital property, outline valuation methods, and specify division terms in the event of a divorce. Christopher R. Castellano, a principal at Joseph Greenwald and Locke, told The Block. However, Some of the most common red flags that suggest a spouse may be concealing funds include unexplained cash withdrawals, a sudden interest in technology, or reference to crypto apps, exchanges, and wallets without additional information, according to Castellano. Asked whether he had seen an uptick in people hiding wealth via crypto in divorce cases, he said attempts at full-scale concealation, or rather concealing, of wealth are uncommon, but surreptitious use of marital money for crypto or concealing of crypto gains is becoming more prevalent. Because a divorce involves several categories of assets, having them identified at the same time with values that you are confident in and time to coincide with a strong crypto market is the biggest challenge. Castellano explained, quote, ultimately, you can't rely on the value of crypto due to its volatility. The court will typically consider the value assigned by the parties as to a particular asset or at the trial date. That makes sense. The pseudonymous nature of many crypto participants presents yet another challenge, particularly when combined with the use of non-KYC peer-to-peer platforms rather than centralized exchanges, for example. However, courts can still issue discovery orders requiring full financial disclosures in response to a failure to produce documents, Castellano said, noting this applies even when someone is operated pseudonymously or via non-KYC platforms. Quote, the difficulty is less in asking for the court to issue relief and more in identifying the asset to begin with, which would likely require expert analysis and tracing to identify the particular asset. If significant crypto transactions are involved, it makes sense to hire a forensic accountant with on-chain expertise, he added. While the treatment of digital asset holdings in divorce proceedings remains a nascent field, and case law is still developing around it, Castellano said courts that will treat crypto like any other marital asset, subject to an equitable division based on factors such as contribution, dissipation, and economic circumstances. Crypto and DeFi transactions can be complex to track and interpret, even for the most experienced users, and Castellano noted that legal professionals and courts' technical understanding is expanding as more information and resources become available, but as with any new legal development, they will often rely on expert testimony, and that's no different when dealing with complex crypto structures. Ultimately, transparency is key as crypto becomes more common in marital estates. Quote, failure to properly disclose crypto can lead to serious legal consequences, and parties should consider involving tech-savvy professionals early on in the process. Yes, let's just go ahead and burn our marriage to the ground before it even begins by completely not trusting each other. That's what this whole thing is telling me. Anyway, having practiced family law since 2013, Castellano advises Maryland and D.C. clients on issues ranging from high net worth divorces, custody disputes, and pre- and post-nuptial agreements, using risk-reward analysis to find the most beneficial case outcomes. Just be aware, this is going to become more prevalent. And the nature of something like Bitcoin, let's just stick with Bitcoin because it's the only thing that makes sense anyway, and combined with the pseudonymous nature of identity that we are now seeing. And we have, it's not like it's new, but when you get these two things in a mix, people were always, telling me like, well, the guy had like another family. Well, that's a lot more difficult. The guy having like another 4 kids and another wife in a completely different town and somehow is able to be at both places with both families, to me, that always seemed like that's bullshit. Nobody can do that. But apparently people do. But I'll tell you what's a hell of a lot easier, to have a completely different identity online than you do in real life. In fact, that shit's been going on for decades. But now we're at this juncture. Like the wife or the husband never would have given shit one about a digital online identity unless it was the cause of the divorce in the first place. But if the divorce was going to happen and somehow one of the parties found out that the other party involved in the divorce had a digital online identity. Who gives a shit? Nobody. It's not worth anything. It's not worth any money. They can't go on the market and sell your identity and take half of it. So nobody gave a shit. But now that's a different deal. It's not just the Bitcoin holdings. It's going to be the Bitcoin holdings as it pertains to a completely separate identity that you have, which also pertains to a completely different financial identity that you have. This guy's saying that we're going to be able to find that all out. I disagree wholeheartedly. If you do it correctly, you'll be able to hide all manner of wealth from anybody that you want to hide it from. If you're dumb about it, you're going to basically reveal the fact that you've got Bitcoin to your spouse. And if that's a problem, then you probably shouldn't have ever been married to this person in the first fucking place. Right? But there's always let's say this. Let's say you get married to the woman of your dreams or the man of your dreams, and things go along swimmingly. You have 4 kids, you got 12 dogs, you got a house out in the country for the dogs to roam on. Everything's brilliant. Your life is wonderful, and then one of y'all gets into a bad car wreck that damages some brain tissue. This happens. I'm not blowing smoke up your ass. Doesn't die, but when they're completely recovered, they're not the same person. They're not the same person that you married, not the same person that you're in love with, that you had kids with. It's a different person. This can sometimes happen. In fact, you don't even have to be a different person coming out of something like a head trauma. You could just have slightly different ideas about certain things that over the next few years cause a divorce, right? So how do we navigate all this? And the answer is, I don't know. It's really going to depend. Like, let's say you get married to the woman of your dreams. She gets in a car wreck, and all of a sudden she's out drinking until all hours of the night and having multiple affairs. And you say, fuck this, I'm going to Argentina. Well, hold on there, pal. When you first got into this marriage, everybody knew that you had Bitcoin, including your wife, who is now causing a massive issue. And in many states in the United States, it doesn't matter if she's at fault, she's going to get money. And that money is going to include part of your stack, if not a full half. So should you have hidden that at the very beginning? Dude, this is a hard thing. And it's going to be another potential wedge in the already frail relationships that we have in between marriages in the United States. It's not good, and all of us should be very, very careful about how we continue to present ourselves going forward, whether it's in marriage, you're just dating, you got a friend, whatever. It's up to you, but don't be stupid. Just saying. Now, on to Prenetics, P-R-E-Netics. Prenetics becomes the first healthcare firm to launch a Bitcoin treasury strategy with $20 million Bitcoin purchase. I just told you yesterday about H100. They're a health tech company. They've got a Bitcoin treasury. So I'm not exactly sure that Bitcoin Magazine's Jenna Montgomery is really having the best headline here, but whatever. Prenetics Global Limited, a health sciences company, announced today that it purchased $20 million worth of Bitcoin as part of a newly approved corporate treasury strategy. The company acquired 187.5 Bitcoin with an average price of $106,712, so they're below water, and stated that its board had approved allocating the majority of its $117 million balance sheet to Bitcoin. It follows the company's strategic transfer of ownership of ACT Genomics, which increased its pro forma cash to approximately $66 million in total liquid assets, including Bitcoin and short-term holdings to around $117 million. According to the press release, quote, with our strengthened balance sheet of $117 million in cash, Bitcoin, and short-term assets, we now have the financial foundation to pioneer innovative treasury management approaches, including our historic Bitcoin treasury strategy. So they've been into Bitcoin apparently for a while. They're just expanding it. There are people, and and I've talked about this before, and you've heard them before, who are really, really, really freaking nervous about this Bitcoin treasury strategy. But let's look at it from just a slightly different point of view. What are you supposed to do with your treasury as a company? You're supposed to invest it. Did anybody say that the fact that, I don't know, let's say Ford Motor Company, back when Ford still probably had some kind of money laying around, that they were buying, I don't know, Heinz Corporation stock. Did anybody say, we're really concerned that we're going to run out of ketchup because all these companies are buying Heinz? And what happens to our ketchup supply if all these companies sell out immediately because they need cash? And it's going to destroy the Heinz Corporation, and therefore there ain't no ketchup for my hot dog. This is bullshit. This entire thing is bullshit. And yet, Andre Bagansky from Decrypt has this headline: is similar scientific flashing a warning sign for Bitcoin treasury firms. Oh my God, please help us all. We're all gonna die. NASDAQ listed healthcare technology firm Similar Scientific was valued at a razor thin premium compared to its Bitcoin holdings on Tuesday, according to the company's website. The firm's MNAV, or multiple to net asset value, was recently 1.07. That means the company's $498.5 million enterprise value, according to or accounting for Similar's market cap, debt, and cash balance, was slightly above that of its 4,449 Bitcoin worth $466 million. Matthew Siegel, head of digital assets research at Van Eck, told Decrypt that Similar is now in a position where many Bitcoin treasury companies may find themselves in the coming quarters, trading close to NAV, or net average value, net asset value, and facing pressure to demonstrate capital discipline. Bitcoin treasury companies like Similar seek to maximize shareholder value by growing the amount of Bitcoin they own per share. When a company's MNAV falls below the number 1, it can no longer grow its Bitcoin per share by selling stock and using the proceeds to buy more Bitcoin. When Similar unveiled its latest Bitcoin purchase this month, the company said in a regulatory filing that it had recently acquired 185 Bitcoin for $20 million. Similar also signaled that it could sell $364 million worth of common stock through an at-the-market program. In a recent interview with Decrypt, Ben Workman, chief investment officer at financial services firm Swan Bitcoin, explained that a discount can spook investors in a Bitcoin treasury firm if they start to suspect that the firm can no longer raise funds in a way that benefits shareholders. Quote, "The company has several strategic levers it can pull to stabilize value," Siegel said. Quote, "If management prioritizes shareholders, I believe the risk reward at current levels is favorable," end quote. On X, Siegel said Bitcoin treasury firms can adopt safeguards, including pausing ATM issuance if the stock trades below 0.95 times its net asset value for 10 or more trading days, and prioritizing share buybacks when BTC appreciates, among other options. In recent months, MNAV has become a popular metric for operating or for comparing Bitcoin treasury firms, as everyone from cannabis cultivators to asset managers have seized upon the trend. But Similar is not relatively a new face, purchasing its first Bitcoin last May. In April, Similar said that it had reached a tentative $30 million settlement with the Department of Justice to resolve allegations of federal anti-fraud law violations pertaining to its QuantaFlow product marketing. On Tuesday, Rosen Law Firm, a global investor rights law firm, said that it would begin investigating potential securities claims on behalf of the shareholders. Similar stock price closed down 6.5% on Tuesday, dropping to $28.38, according to Yahoo Finance, and the company has the 10th largest Bitcoin treasury by dollar value, just behind video game retailer GameStop, according to Bitcoin Treasuries. Siegel noted that legacy business issues, which have worsened, may be weighing on Semler's MNAV, along with a small market cap, low liquidity, and limited convertible bond issuance. Some analysts have warned that if Bitcoin's price falls below a certain level, it could force companies to sell their Bitcoin, reversing buying pressure this year. Again, that's the end of the article. It's not that it's fear, uncertainty, and doubt that's being sown here. I mean, there's real concerns, but I'm always going with the tenet: can you stop Semler Scientific from buying Bitcoin? If the answer is no, and it better be, then we've got to move on to greener pastures and worry about something else, or not worry about shit at all. Just stack sats. I don't know what else to tell you, but right now, Strategy is trading at twice MNAV, like 2.01 or something like that. So the valuation of the company is twice that of its Bitcoin holdings and debt and all the rest of its stuff. But mostly it's driven by its Bitcoin holdings. I don't like that. Okay, so, well, Dave, what do you like? Honestly, I kind of like the MNAV closer to 1. Why not value the company the way for what its value actually is? You know, this MNAV yield, or this MNAV metric, where it's like, see, our MNAV is going up, so therefore each shareholder has more Bitcoin per share. But you don't, as a shareholder, own any Bitcoin of Strategy if that's the stock that you own. Same thing with Semler Scientific. If you own shares of Semler Scientific, you don't own any Bitcoin. You have no claim on the Bitcoin. You sell your stock of Semler, all you're going to get is cash in US dollar amounts, or Japanese yen, or whatever the hell your fiat of the day tends to be. That said, I do think it's better to have an MNAV that is not multiples of your asset balance sheet. I don't think that that's good. I just don't. I think we need to come back down to reality here. Like I've told you this story before. Back in the 80s, when my dad was starting to tell me about what stocks were and how they worked and why people had them at all and why we should give a shit, he was talking about buying stocks that had no more than a price to earnings ratio of somewhere between 4 and 8. Go find me a stock that has that P to E right now. You can't. You're talking about 50s, 70s, 100s on P to E. So I buy a share of stock for $100. Its earnings is $1. That is a price to earnings of 100 to 1. You don't, my dad would have blushed if I had come to him even considering buying such a thing. So I think, honestly, I don't think I would be looking for MNAVs of 1.2. I think that's a good number. It's not so high that it freaks me out, but it's not so low that it gets to the point where we start dealing with that, well, if their MNAV dips below 0.95, they could start selling their Bitcoin. I'm not even sure that that's true. We'd really have to actually talk to somebody like Saylor to say, you know, I don't want to ask the question, at what point do you sell your Bitcoin? At what MNAV do you have to start selling Bitcoin, if at all? And if you don't, then how do you fix your MNAV? Or is fixing your MNAV even a deal? And I know Saylor's going to say, yeah, it's kind of important because it's a metric that he's using to entice new investors. And if the metric is flashing a bad signal, even though it's new, we're starting to learn all about it, that could cause him problems. But he might look at me and say, I don't need to sell my Bitcoin. Here's how I'll fix it. And I would give you an example of what he would say, but I don't know. I've never talked to Saylor. and I'm probably not going to. So we have to conjecture on that one. At the end of the day, let me give you some suit speak there. I think having a not so high MNAV is actually better for the overall health of these Bitcoin treasury companies than it is to have it too damn high. And I'm looking at strategies saying your MNAV is too damn high. Bring it on back down there, brother. And I don't know why I say 1.2. It's not like I'm an economist. You know, I'm certainly not a Bitcoin economist that knows everything there is to know about MNAV, but gut feeling, 1.2. Let's move on to Bitcoin news. Vinaz raises 3.58 million pounds sterling as retail investors back Bitcoin strategy. So we've got another one. Bitcoin-focused company Vinaz Limited has raised a shit ton of money. Well, 3.58 million pounds sterling, more than triple its original target of 1 million pounds sterling as it looks to boost its Bitcoin holdings and expand across North America. The fundraising announced through the London Stock Exchange shows growing interest in Bitcoin from private and retail investors, particularly in the UK, where they are limited, regulated, and exchange-listed options for Bitcoin exposure, or there are very limited, regulated, and exchange-listed options for Bitcoin exposure. Vinaz is listed on the LSE under the ticker symbol BTC.L. Okay. And said the funds will be used to buy Bitcoin and support its ongoing Bitcoin mining operations in the US and Canada. The company is also planning to rebrand to become the London Bitcoin Company, or LBC. I actually like that name, the London Bitcoin Company. For some reason, I'm getting the East India Trading Company vibes. I don't know why I say that, but London Bitcoin Company, good name. It's a good name. Not so much with East India Trading Company. We won't get into that one. Quote, this raise reflects growing interest in our LSE listed Bitcoin strategy and helps accelerate our goal of becoming a leading UK main board listed Bitcoin company, end quote. The majority of the funds, was about 3 million pounds, came from retail investors through the WRAP platform, a structured offering that allows public participation in company fundraising. This is one of the largest raises on the LSE's WRAP platform by a small cap company. A further 550,000 pounds sterling was raised from institutional subscribers. Vinaz has a growing network of Bitcoin mining facilities across Indiana, Iowa, Nebraska, and Texas in the United States, and Labrador up in Canada. They are hosted by third-party facilities and supported by around 700 mining machines. So it's a very small operation. With Bitcoin prices up over 75% since April 2024, the company is acting fast to build up its Bitcoin reserves. So we got another one, and I'd never heard of Vinzan Mining, but I don't know. London Bitcoin Company sounds awesome. I don't know why, but London LBC, I like the name. Anyway, so that is it for the end of the show, man. I hope I brought you some news that you can use. I hope it's something that calms you down. I really think we need to take a deep breath about everybody losing their ever-loving mind and becoming hysterical about Bitcoin treasury companies. A, because there's absolutely fuck all we can do about it. And B, what are they supposed to do with their treasuries? Buy art? I mean, how is it that you would not be, that the detractors of this strategy would not, how would you be able to not have to say the same thing about anything else these companies are buying? I'm very concerned about how much money is going into the New York Stock Exchange in these, 250 different stocks by all these companies that are trying to lever up their damn reserves. Why wouldn't you leverage the money that you've made in your company? Isn't that what you're supposed to do? I think it's overblown. I think we should exercise some caution as to how much we let MNAVs rise. Again, I'm looking at 1.2. I don't know why. But when we get to strategy territory and we get above 2, maybe we should look at that and go, I don't know. maybe we should buy something else. Maybe we should actually, oh, I don't know, stack sats about it, and I'll see you on the other side. This has been Bitcoin and I'm your host, David Bennett. I hope you enjoyed today's episode and hope to see you again real soon. Have a great day.